Turn off your mic, please. In our last class, we talked about market structure. We talk about In our last class, we talked about introduction to market structure. So market structure is a pattern market used to make to approach two zones. And these zones can be higher time frame key level. It can be an order block or a breaker block. A market started reacting from zones, higher time frame zones. We want to talk about that in our next class when we go to directional bias. So we know that anytime you see market reacting to a zone, just know that it's a higher time frame key level, a higher time frame order block, or higher time frame breaker block. And when you see market reacting from any zones, it's either higher time frame key level breaker block or higher time frame order block. You have to keep this thing in your mind. So this structure, the kind of pattern market used to make to approach these two zones is called a market structure. In market structure, we talk about there are two types of concept market, three distinctive pattern why market makes its move. We know that market is either making it move towards to fill an imbalance, or market make a move to grab liquidity, or to go to intended direction. Anytime we have impulsive move to the downside, we expect a correction move to happen before another impulsive move. Then we expect another correction move to happen before another impulsive move. This is a healthy movement of a market. For markets to go healthy, markets to go in a why we expect markets to move is like this. Anytime we have this impulsive move, we expect a correction move to happen. This pullback is a correction move. And all of these two moves are coming from a higher time frame key level. This correction move come from a higher time frame key level. This impulsive move come from higher time frame key level. So for markets to maintain a current structure in what it wants to go from a bearish market, for markets to maintain a structure, a bearish structure, it needs to keep breaking lows. This for markets to maintain this current structure, this recent low that market need to come and take it out. So if we know that a correction move will come, then this impulsive move will come and make market break below this low. And we expect another impulsive move, and then correction move, then another impulsive move. So if you see that all of these two move, this correction move, and then this impulsive move, all of them come from a zones. We talk about these two zones that we expect for market to maintain this current structure. We know that this is clearly.
Your voice, we are not hearing you, sir.
You cannot hear me?
It's clear now. It's clear now.
Okay, sorry. We talk about three patterns make a move. It's either trend or ranging. I'm just briefing you about it's not clear as calculate work. So for markets to maintain this kind of current structure, we want to see what market keep go to the downside, creating a lower low, lower high, lower low, lower high, lower low. This is a downtrend, right? And we talk about an uptrend. This uptrend is when market keep breaking a highs, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. This is how we determine an uptrend. This is how we determine an uptrend. So we know that the other types of market movement is a ranging market. When market ranges from two zones, higher time frame key level, order block or breaker block. From these zones, resistance level to support level, resistance level to support level. Resistance level to support.
No, I see code.
Please turn off your mic. Okay, let's continue. So this is what we talked about in the last class. So we know that a market structure is what? Is the same thing. A market structure is what? Is market what? The current price, the current structure market used to make to approaches these two zones. From this what? Higher time frame is our order block or breaker block to this what? Higher time frame key level is our order block or breaker block. This is what we talked about. So we know that any two types of zones where we expect markets to react it from. A market coming from this zone now to this zone, there's some kind of structural market used to make. This types of pattern, this types of price action called it what? A market structure. So this is a brief explanation of what we talked about yesterday. In this class, we're going to talk about one of the point of interest we're going to use. And we have two different types of point of interest we normally use when it comes to market structure. I'm going to talk about this, then we're going to show you inside the chart. So I just want to I think I'm going to have to add another class because 2 classes in a week is too low for you guys, because I want to go as slow as possible because there's a lot of things I need to talk about. And then I cannot just talk about them in one video, all of them in one video. Yes, please stop what you're doing. So I cannot talk about them in one video. Sometimes, unless you're asking me questions about the things, I cannot specifically comment on my mind to talk about it. So you have to excuse me for that. So in this class, we're going to talk about point of interest. We have 2 points of interest. There are 2 zones we expect this reaction to happen. I just explained a key level is a high time frame key level that we expect markets to tapped into before we expect this move to the other upside, this move from here to this zone, then from that zone to this zone. We know that all of these 2 zones are key level, and this key level are point of interest. We call them it's either order block or breaker block. So in this video, I'm going to talk about what is an order block, and then I'm going to talk about what's a breaker block. So an order block is is a consolidation before moving to the either upsides or downsides to break a structure. This is a bullish order block. A bearish order block is consolidation before moving to the downside, and this leads to cause a break of structure. These are order block. Order block is a zone where there's a lot of institutional orders. We know that market makers, they're institutions, they're banks and hedges that control these financial markets. Me and you that use $1,000 or $2,000 to enter a market, we cannot move BTC because even the market cap of BTC is over $3 trillion. So unless bigger amount of money enter the market, we cannot move BTC. So our job is to follow this smart money. We call them smart money. That's what from the strategy SMC. They're smart money. They have bigger money. They're the one controlling the market. We are following their footprints. We follow their footprint to trade the financial markets. We follow their footprint to know when are they going to enter the market. Then we follow them to take advantage of these bigger monies they they bringing inside the markets. They bring a lot of money inside the market and move the market. So we take advantage of that, then to follow them, to follow their footprints. This is why what the strategy is all about. To follow this bigger money, smart money, to trade alongside them. So this is what I'm going to talk about. An order block is a area of consolidation before a moving up to the upside. And that moving up cause a break of structure. This is how you determine an order block. An order block is area of consolidation. There's a lot of institutional orders. There's a lot of orders of BTC, buy orders here that have been executed that cause these markets to buy massively like this. And this buy leads to break a structure to the upside. To break a structure to the upside. This is called an order block. Anytime market returns to this zone, we expect the same thing to happen. Another institutional order executed at that current zone for market to keep pushing up. So the psychology behind an order block is that when you come to, let's say, for example, you come to your house by 10 p.m., then you find out that your dad what closes his door by what 10 p.m. So when you come back tomorrow at that same time, 10 p.m., what do you expect? Can anyone answer me? I want this class to be an interaction class.
You meet the door very close.
Okay, you expect the door to be closed because what? Yesterday you come at the same time, you find the door closed. So when you come today again, you expect this door to be closed. So this is it. Like this is the what psychology behind a order block. So this zone, there were a lot of institutional order that caused markets that caused this buy. So anytime market return to that zone, we expect the same things to happen. Are you guys following up?
Yes, sir.
So how do you mark an order block? We mark an order block for a bullish order block. We want to see a what? A bearish order block, then a what? A bullish order block engulfing it. This is a what? A clear, sorry. For a bullish order block, this is like a candle. I give you example as this is a candle, and this also is a candle. So to mark a bullish order block, you want to see a what? A bearish order block, a bearish candle, this candle, bearish candle, this black candle, then a what? Bullish candle engulfing it, which is what? Covering it. This is how you marked what? Your order block. This candle is your what? Order block. This bearish candle, this is how you marked an order block. I will repeat again. An order block is what? It's a zone that there's a lot of institutional orders. There's a lot of what? Smart money orders that have been executed at that zone. And this execution of order what? Cause a what? Previous break of structure to the upside. It caused a what? Previous break of structure to the upside. This is what? A valid order block. Anytime market returns to this zone, we expect what? The same things to happen, which is what? This buy orders being what? Executed at that the same zone. To mark an order block, for a bullish order block, the red candle and then a what? Green candle what? Engulfing it, covering it off. To mark the order block, you mark the what? The old candle, the what? Bearish candle. This is how you mark the order block. There are two rules when it comes to marking the order blocks. When your order blocks, I'm going to explain the theory part so that I can show you inside the chart. When an order block, when you want to mark for a bearish order block. Now we talk about for a bullish order block. For a bearish order block, you want to see a bullish order block, then a bearish order block what? Engulfing it. Yes. A bullish order block, then a what? A bearish order block engulfing it. And to mark your order block, you mark this bullish order block. This is how you mark what? Your order block. This is a what? A bearish order block. So anytime market returns to this zone, anytime market returns to this zone, we expect a what? The same what? The same order that had been executed that caused this massive buy to what? To happen again. This is the psychology behind an order block. There's one of the form of interest we make use of, which is what? The breaker block. Sorry, I said there's two rules when it comes to what? Picking a what? A proper order block. How do you mark your order block? When you have an order block that has a lot of wicks, I am not going to explain this because this class it's not supposed to be a what? Beginner's class. A wick is what? This rejection of a candle. So when a candle has a wick,
I hope you're not talking because I think we cannot hear you.
you cannot hear me? Please, can the other guys hear me?
Yes, I can hear
Yes,
you.
I hear you.
Yes, sir.
I can hear
Yes,
you.
sir. I can hear you.
Okay, I think it's from your end then.
Okay, I think it's from your end then.
Everyone is hearing me. Okay. For you to mark a valid order block, when you have a bullish order block, when you have a what? A bearish candle, then a what? A bullish candle engulfing it. This is to mark this order block, you first need to consider this week. I'm going to repeat this only once. If this week is longer and the body is shorter, you're going to use only the lower wick to mark your order block. If this wick of this last candle, I just show you how to mark a bullish order block candle. If the wick of this candle is shorter, is longer than the body, you're going to use only the wick to mark your order block. You're going to use this wick to mark your order block. If the wick is shorter than the body, if the wick is shorter than the body, you're going to use whole of the wick and the body to mark your order block. Like this. This is supposed to be a beginner's class because class, but I'm just doing that because this class is very important. We need to understand all of this before we go into the full detail. So this is how we mark your order block. There's one of the point of interest that I talked about. I said anytime market is buying or selling, there must be a zone that market reacting from. This a zone are higher time frame key level. So key level, higher time frame key level can be either order block or a breaker block. So I just explain what an order block is. So what is a breaker block? A breaker block simply means it's a failed order block. A breaker block simply means it's a failed order block. When market was trending down, we know that these are all an order block because this one caused a break of structure to the upside. Institutional orders that cause break of structure to the downside. This is how you mark an order block. This is also an order block. Why? Because it caused a break of structure to the downsides. So these two now is a perfect order block based on what I teach you. So in the next class, I'm going to teach you about what you have to look for when we come to the liquidity class, how you're going to look for a valid order blocks. This is a two order block, but just because the order block, that does not mean there's all of these order blocks are you going to use them? Because if order blocks they can be used, anyone can be profitable by now. Because everyone, 98% of traders you see, they buy from order block and sell from a breaker block or a resistance level. So in the next class, we're going to talk about liquidity. We're going to talk about which types of order block should you use and why you should avoid them. So any of these zones, psychology behind all of this is when market returns to this zone, we expect the same sell to happen at this current zone. At this current zone. So there's scenarios that market will not sell from these zones, which we're going to talk about when it comes to directional bias. When market taps into a key level, we know that a buy comes from a key level and or sell come from a key level. We know that any structure market was making is in this zone. This sell that we see, so we know that definitely is coming from a higher time frame key level. So when market tapped into another higher time frame key level, where we expect markets to started buying, it will buy and push above all of this current high that market just make this order block. It will disrespect this order block, invalidate this order block, threatens to breaker block. So this one is an order block. So I said a breaker block is a failed order block. This order block supposed to push price down. But because market tapped into a zone where you expect a what? Reversal, then market what? Take out this order block. But to markets to maintain this current structure, it must not break this order block. But market now tapped into this demand zone and market break these two zones. You have multiple breakup structures. So all of these two zones now is your what? Point of interest. You can still use those two zones to buy the what? Continuation of these markets. You have three possible zones. This order block and then these two breaker blocks. All of those zones are what? Point of interest you can use. So when we come to talk about the point of interest, we're going to use, these are the types of zones we're going to choose because there are some methods we use when choosing any point of interest. Let me show you inside the chart. This is a BTC USD, 1 day time frame. Clearly, this is a what? Beginner-friendly market structure. Market keep breaking what? Lows. Breaking low, a high. A low, a high. A low, a high. Then another low. Market just create a what? Another high. For markets to maintain this bearish structure, we expect a what? Another markets to what? Take out this low to create another what? Recent low. For markets to complete this cycle of what? Downtrend, the target of this market is what? Taking out this low. Taking out this low. So there are zones that we expect what? Impulsive move to happen. Then there are zones that we expect what? A reversal move to happen. All of these two zones are higher time frame killable, either breaker block or order block. I'm going to mark few of these two zones that we expect this. You see, this one is a breaker block. It was an order block that fails. A market tapped into that zone and this impulsive move what? Come in. This zone is a high time frame order block. Market tapped into this zone. Market tapped into this zone for this what? Correction move to come, and then tapped into this high time frame key level for this what? Impulsive move to happen. For in order for markets to maintain this current what? Downward structure it started. So another, this zone, this correction move that comes now is also from a what? Higher time frame key level, which is what? This order block right here. This order block right here. So if you see that now, to read a structure like this is very simple. The reason why I say we're going to talk about advanced what market structure is that you need to understand the basic before you go to there. Because we're not going to trade a higher time frame. We're going to trade a lower time frame. We use the higher time frame to know where market is reacting to and what is the current direction of the market. So you see, anytime we have impulsive move, market what? Come back and what? Tapped into this zone. And then now another what? Impulsive move. We expect this one to be a correction move. And then we what? To what? For markets to maintain this current structure, we want to see another break to the downside. Where do we expect this one? Is because market just invalidate this order block. So if we draw this one like this, we know that market tapped into breaker block and market's currently reacting from that breaker block. So based on the concept I explained yesterday on our last class, I explained the concept of what? Continuation and concept of reversal. For concept of reversal is when market is what? Approaching, making higher highs, higher lows, higher highs, a low, a high, a low, a high, a low. So when markets tapped into a what? Higher time frame key level, that can be either breaker block or order block. This is where we expect a what? Markets to push and break this order block. This is when we have what? Market structure shift. Did we talk about market structure shift yet in our last class? Can you guys answer me? Did we talk about market structure shift when I talk about reversal and then continuation concept?
Yeah.
Lawrence, can you hear me?
No, we did.
Do you talk about market
Yes,
structure?
sir.
Yes, sir. Yes, sir.
No, no, sir.
Okay, when markets, mute your mic. When markets tapped into a higher time frame key level, like what market currently do on BTC, I like to be showing you inside the chart at the current price action. I don't want to be going in minor like last year or 2 year price action. That's not necessary, because I have to be showing you in the current price action. Currently, we know that market tapped into what? A breaker block. Why is it a breaker block? Because it was an order block. Let's confirm it's an order block. To confirm it's an order block is what? Break this structure, if you can see. It breaks this high, it breaks another high, it breaks this high too. So we know that definitely this is a what? An order block. Definitely this zone is an order block. There's a lot of institutional orders that cause all of this breakup structure. Are you guys following up? Do you guys understand? Please answer me. Do you guys understand?
Yes, sir. Yes, sir.
Okay.
Yes, sir.
So we know that definitely this is a what? An order block. So see what happened when markets tapped into it. What it just give us that what correction move for markets to maintain this current direction it wants to go, which is what? The bearish trend. And then market come back and what? Invalidate this zone. Market come back and what? Invalidate this zone. Now market come back and what? Use this order block as a what? Breaker block. Market just tapped into this breaker block. So that's when we expect what? A market structure shift to happen. For market structure shift to happen, we need to look for what? Lower time frame structure. We know that anytime market, someone says, I did not talk about market structure. A market structure is when what? It's a sign that we use for what? Concept of what? Reversal. It's a sign market used to tell you, want to tell you that the current trend is about to end. I'm going to give you an example in a bullish market. When market is making higher highs, higher lows, 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 and market tapped into a key level. I'm going to explain all of these things when we come to directional bias. I just want you to have this thing on your mind. There are key level. Key level is zones, either order block or breaker block that we expect reversal to happen. It's a zone that we expect a lot of institutional orders. I just explained what an order block is. We expect a lot of institutional orders. It's either to push the market to keep the buying or what? To push the market to start selling. So we know that anytime market what? Break a high, anytime market what? Break a high, it creates a what? A new higher low. Break a higher high, it creates a new higher low. Break a higher high, it will create a new higher low. Create a higher high, it will create a what? A new higher low. Create a what? A higher high, then it will what? We expect markets to what? To create a new lower high before pushing up to the downside. So anytime we know that all of these two zones, the market, all of these two zones, we know that they what? Order blocks. Market what? Use them to buy market from. There's a lot of institutional orders. So anytime markets invalidate this last high, the purpose of last high, this low now, is what? To break to cause a breakup structure to the upside. Did it turn up your camera? To break up structure to the upside. This is the purpose of this low. The purpose of it, the job of this low now, this current low, is what? To break a structure to the upside, which is just this. So what? This low now is called a what? A protected low. We're going to talk about that when we come to the liquidity concept. So for these markets to maintain this what? Upward structure, market will create another low and then what? Push above to create a new high. So when market fails to do that, instead of creating a new high, now market come back and take out this last low. So this confirms to us that this market doesn't want to what? Keep what? moving up to the upside, we have a market structure shift. This is called a market structure shift. When market take out the last low before the high, this low is a protected low. It should not be broken if this market wants to maintain this current bullish structure. So anytime market take out this low, so this is when we have a market structure shift. Are you guys following up?
Yes, sir. Understand.
Okay. And we expect a market structure shift to happen, not anytime. You can have something like this. Market will create this low and then come and take out the low. You will not call this market structure shift because the sell is not coming from a key level. Unless these cells come from a key level, which is a higher time frame order block or a breaker block from this zone, then cause these markets to break this last low. That's when you have a market structure shift. Then you're going to look at your liquidity, then your point of interest, one of these two that I just talked about, to look for reversal concept. For markets to reversal, because this market doesn't want to no longer wants to maintain this current bullish structure. So this is, when we talk about liquidity, I'm going to introduce 3 types of liquidity we're going to use to take advantage of all of these things. So this is a brief explanation of market structure. Let me show you in the chat, because I don't like teaching only on this. I'm doing that because for you to understand, so that if I'm teaching and showing you in chat, you'll not be surprised when you see something different. And I like questions. I want people to ask me questions. After this class, when you watch this video, go and study it. Pinpoint your question, write them down, come to my DM, either WhatsApp or in Telegram. Ask me questions. I will get my time to answer all of your questions. I like questions. I like to answer questions because for me now to teach you everything, I might forget something not to teach you now. But when you ask me questions based on what I teach you, then I will be able to answer the question for you. So sometimes I will be teaching you, but there's something I should be teaching you currently, but I will forget until you ask me a question about those things. So please, you have to write questions. You have to be writing questions. Later on, you come to my DM and ask me questions, and I will get my time to answer all of your questions. So we know that definitely market tapped into a higher time frame breaker block. I explained this zone, right? So your next job is to go to lower time frame to look for market structure shifts. When market did not give you market structure shift, that means market doesn't want to sell from that zone. To look for market structure shift, you need to read current market structure. Any zone that you see market got invalidated in between this zone, inside this range, when market did not come and tapped into this higher time frame key level, which is this breaker block, don't expect it to be a market structure shift until we come to trading lower time frame, which I'm going to, if you understand how to trade lower time frame, that's when we use to multi-time frame analysis to do different, to look for our entries and to look for our continuation entries. So the first thing you need to do is to rate the structure in the lower time frame. You don't just tapped into that your zone that you expect this impulsive move to come for markets to maintain this current bearish structure, right? So you come to lower time frame, 4 hour or 3 hour or 2 hour, the one you can read the market structure, because you understand to read market structure when you trying to read it in different time frame. When one time frame is not clear for you, go to lower time, different time frame, and then look to read it in different time frame. For example, this one is 4 hour. If it's not clear, I can go to 3 hour and read the structure again. So let's start from here. So we know that for us to read this structure, we know that we have a higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, higher low. This is our last low that caused this breakup structure. We get a higher high. So for us to confirm a market structure shift, which zone do we expect markets to break? Can anyone answer me? Yes, can you answer me? Gabriel. The last low, which is our last low? This one, right?
Yes, sir. Yes, sir.
Yes.
All right. So unless market come and invalidate this zone, and this zone is an order block. if you can see, we have another zone, which is what? The breaker block. For markets now, if we are to, because we know that in lower time frame market is bullish, right? So we're still going to what? Continue buying the market until market what? Prove us otherwise. Until market was tell us that, okay, I approach that higher time frame key level and I expect to sell from there. Until market come and invalidate this zone, we'll be looking for what? Buys. Because market this one is a protected low, it just break this structure to the upsides. So we expect markets to come to any of these two zones that I explained this in this video. I don't want to be like going super. That's why I said I'm going to have to add another class for you guys, because I want you to go very fast. So anytime market tapped into any of these zones, what are you going to look for first? You're going to look for what? Market structure shift at any of these zones. Then you look for what? Continuation to what? To break this high that market what currently generate, right? For markets to what? To maintain this bullish structure. So when markets tapped into this zone, and it did not give us a reversal concept, which is what? The market structure shift, then we what? Expect it on these zones. If market tapped into this zone again, did not give us any structure shift, so we know that market doesn't want to buy. Market is about to turn bearish to what? To maintain the higher time frame structure. To read for market structure shift now, we know that these are the two possible zones we expect markets to tap into before we expect a buy. So you can go to, again, lower time frame to read the structure, market used to make while approaching this zone. This is a 15-minute time frame. So if you read this zone, you know that you have a what? A high, a low, a high, a low, equal high, a low, a high, a low, then a high. Now you have another low. You expect this one to be a high. Then you expect markets to give you another low. Expect markets to give you another high. When market tapped into this zone, that's when you'll be looking for, okay, let me see if I can have a market structure shift. So when market break this last order block, this recent high, that's when you have a market structure shift. Then you know that it's a sign for what? Reversal. Market what? Finish this selling. Now it's time for market to reverse and go and continue in its journey to what? To take out this high. Do you guys understand?
Yes, sir.
So this is like brief of what I am going to talk about in this class. Please, guys, you should go and learn. You should go and see this in different pair. If there's the only other pair, because I only trade gold and BTC, that's why I'm analyzing on BTC. But if you have any other pair on mind, you can come to me. I can answer your questions. I can even fix class for you to answer all of your questions in different pair. Based on what I teach you, ask me question about what I teach you. So this will be the end of this class, because please, I have a Zoom meeting on this CEO of this funded next. I request people out, and this man says I need to answer some questions. So I'm going to have meeting. So this will be the end of this class. See you guys in the next class. Thank you.